Most day traders use candlestick charts for day trading. They identify the trend pattern, figure out the good timing for entry and exit position based on their trading strategy. So understanding the candlesticks and using the candlestick charts in the right way are very important. It can help you to increase your winning ratios and avoid unnecessary stop outs. In this video, I'm going to cover the following topics. Number 1, the candlestick basics. I'm going to show you the basic knowledge about the candlesticks. Number 2, how to use the candlesticks in day trading. This is the most important part for this video. And there are two ways to use the candlesticks in day trading. First, identify the market strength. Normally, in a strong market, it's very easy for us to identify the setup and use our strategy to enter the trade and take profit. However, on the contrary, if the market is very weak, it's normal for you to get stop outs. Second, how to use the candlestick as signal bars. A good trend will start with a very good signal bar. However, not all the candlesticks can serve a signal bar. I'm going to show you how to find out the perfect one for day trading. Number 3, I'm going to use a trading example to show you how to do the trading using candlestick charts and how important the candlesticks play in the trading. Normally in the candlestick chart, you will see bars with two colors. One is green and the other is red. So in the candlestick bar, in the middle, the solid part is called body. And at the top and bottom, it's called wick or tail. Most of the time, the body part will show the strength of the market. The larger this part, the stronger the market. At the top, it is called resistance. That means that when the market goes up, the seller will push it down. And the bottom calls the support. When the market goes down, the buyers will push up. In terms of the whole candlestick, the middle part, the body, will account for 90% of the market strength. So we'll focus more on this body part. Normally, we call the green bar the bull bar and the red one bear bar. So the bull bar will start with the bottom of the body. That's the open of the bar. And then it could first go down to the low, and then it goes up to the high. And then in the end, it closes at the top of the body. This is a bull bar. That means the market is going up. It's the similar logic for the bear bar as well. Open, high, low, and close. The bear bar means the market is going down. Here's an example for the ESE Mini S&P 500 futures contract. So you will get the data from the brokers, like in this format. First, the market will open at 4514.75. And then it could either first go up to the high or go down to the low. Doesn't really matter. However, in the end, it closed at the 4575.75. This data format is very important for you to remember because almost all the brokers will provide the historical data in this format. Open, high, low, and close. Another thing is that if you want to build some programming to test your strategy, you need to download the data in this format, and then you can build codes to take these 4 numbers from the table as well. In terms of the color of the candlestick, normally they are green and red. However, you can customize the colors as well. And some traders prefer the black and white. It really doesn't matter. However, using the strategy with different colors, that means you care about the direction of each bar. There are also other traders that don't like the color of the bars. They don't want to differentiate the bull bar and the bear bar. So they will use pure color like white or black. It's really based on your strategy. For 2 bars next to each other, there could be 2 scenarios. The first one is the previous close equals the current open. Here's an example. This is a 5-minute chart. For the bar at 10:30, the close is 68.9. It's the same for the open for the next bar at 10:35. The bar will be something like this. You can see that the close and the open are at the same level. The second scenario is that for the bars next to each other is that the close of the previous bar is different from the current open. Here's another example. This is a daily chart, and the candlestick at November the 9th closes at 83. However, on November the 10th, the open is 83.38, which is 38 cents higher than the previous close. You will see something like this. So there's a gap up, basically. Here are the examples of the two bull bars consecutive to each other with the previous close equals the current open. And here is the example of the consecutive bear bars, but there's a gap. Normally, if the previous close is the same as the current open, it doesn't really tell us much about the market. However, if there's a gap up or gap down, it tells us the market strength. So we'll focus more on this situation. I will talk about this later on. Why the previous close doesn't equal to the current open? There are two reasons. The first reason is the market is not continuous. Normally, it will happen on the weekly chart and the daily chart. For example, on the weekly chart, the previous bar will close on Friday for the futures market. However, the next bar will start on the evening of Sunday. So that's why in between there's some time, there might be some news released and the market reacts to the news. That's why there's a gap up or down. The second reason is because the market moves so fast, especially with increasing volume. So, for example, in the 5-minute chart or even the 1-minute chart, within 1 second for the next bar, the market already moves away from the previous close. That's why. And then it's a very good signal for the strength of the market. All the candlesticks can be classified into the following category. The first category is strong bars. You can see the body accounts majority of the candlestick. This is a very good indication of the strength of the market. The next category is the weak bar. You can see the body is smaller, and it really depends on where the body is. It's at the top, at the bottom, so it will give you the signal on the market direction. However, it is weaker than the strong bar. When the body gets even smaller, we could have the hammer or the inverse hammer, or there are other names from other websites. It really doesn't matter. It's just like this. And it could be the signal for the uptrend or downtrend because the tail at one side is very large. The next type is doji bar. So basically the close and the open are at the same level. So this is a very specific type of candlestick bars. However, normally doji bar won't serve as good signal bars. And if the close and open is the same as the high or low, we can also call it pin bar. So the doji bar and pin bar won't be good signal bars. We have just covered the types for the single candlestick. Now we move on to the combination of multiple candlesticks. There are 20 or 30 types of different candlestick combinations. Here we only talk about 3 of them. The first one is engulfing. So this is a bullish engulfing pattern. So basically, the first bar is a bear bar, and then the next bar is a bull bar. The bull bar closed above the bear bar, indicating the reversal of the trend. The second pattern is the morning star. So first the market goes down with a bear bar, and then it gap down with another weak bar. And then the third bar is another gap up with a bull bar. This also indicates the reversal of the market. The third type is the 3 white soldiers. So basically the first bar and the second bar and the third bar, they are all bars with no wick at the top and the bottom. However, the second bar will open in the middle of the first bar. The same thing for the third bar. It opens in the middle of the second bar. These three bars indicate the strength of the market of going up. These candlestick patterns worked very well in the old days because in those times, the market volume was very low and also the information was not efficient among the buyers and the sellers. However, as the technology advances, people are using computers to assist their trading. Especially the institutional investors will use computer programming, especially the high-frequency trading. So nowadays, this pattern won't work very well. So I don't recommend to use these patterns. We should focus more on the signal bar, the single bar, rather than the combination of different bars. For example, this is the engulfing pattern, and then I will ask, what about this pattern? Even though it is not a perfect engulfing, however, the bull bar here is very strong. It also indicates the reversal of the market. The next pattern, the same thing. The bull bar body is larger than the bear bar body. It is also a very good signal bar for the bull bar. The next one as well. The only time we need to care about the bar before it is in this situation, that the previous bar is much larger than the current bar, like it's 2 times larger than the current bar. That means the market is uncertain, or we have to wait for the market to confirm whether it is a reversal or not. It is the similar logic for the 3 white soldiers. If it indicates the strength of the market, what about these 2 patterns? We can still see that the consecutive bull bars means the market strength, even though they have tails at the top and the bottom. We have just covered the candlestick basics. Now let's move on to the most important part of this video, how to use the candlesticks in day trading. Mainly, there are 2 ways for us to use the candlesticks. The first one is to tell the strength of the market, and the second one is to find out the signal bar. Why do we want to know the strength of the market? First, let's have a look at the issues a beginner trader normally face. Have you experienced the following? After you pull the trigger to enter a position, however, the market doesn't go anywhere. So it moves around your entry level. Sometimes you have a small profit, and sometimes you're having a small loss. And then you're not confident enough to hold your position, and then you choose to close your position, either above the entry level with a little profit, or maybe below the entry level with a small loss, or even sometimes you could get a stop out. The second scenario is when the market goes your way, you're happy, however, it doesn't go far enough to reach your profit target, and then it goes back down, and then the situation is that you could be in a loss or you could be in a small profit, and this time you will question yourself, why should I put the profit target so high? Should I just take the profit and exit the market? And then in the end, the result could be that if you manage your trade well, you could get a little bit profit or even break even, and sometimes you could end up with a loss. One of the reasons for these issues is because the market is not strong enough. So let's have a look what a strong market is. So in a strong market, first, the market moves very fast. So after you enter the trade, you will see the market goes your way right away. It won't linger for a long time. And second, in a strong market, you will see the pattern is very clear. For example, you're trading the open triangle, you're trading the wedge. So all the patterns will be very clear to you. It's tradable. Third, and then in the strong market, there will be multiple opportunities rather than just 1 or 2. So you can re-enter your position or you can add up your position as the trend goes on. And then the fourth, so the profit target should be very easy to reach because the market is strong, and then usually it follows the measured move, and then you can take your profit as very comfortable. On the contrary, in a weak market, the weak market will have all the characteristics on the opposite side. And for the issues we mentioned before, probably you're trading in a weak market. And this is why we want to identify the strength of the market to avoid losses, because in a strong market, there are higher probability to get into a trade and take the profit. So how do we tell if the market is a strong market or weak market? So there are three ways to tell whether the market is strong. The first one is we can use a single trend bar to tell whether the market is strong. To be classified as the single trend bar, the bar has to have a body of larger than 60% of the whole candlestick. And also at the same time, this bar should be at least 2 times than all the other bars in the same screen. Let's have a look at some of the examples. Let's have a look at this chart. We can see that this bar is a very good trend bar, is a bad bar. The body is larger than 60% of the whole candlestick, and at the same time, it's at least 2 times larger than all the bars on its left. So upon seeing this big bad bar as the trend bar, you should be prepared to go short. And then after the pullback here, there's a bull bar pullback and then another bear bar. You should enter your position for short, and then the trend will go down. You can also do the measure move for your profit target. If you measure the height of this trend bar and then do the same measuring from the top of the pullback and then measure down, so the market should go down at least the same as the height of this trend bar. There's another example. On the right, we can see this bull bar can serve as a trend bar as well, because the body is larger than 60% of the whole candlestick and larger than all the bars on the left. And then after the pullback, you should find a good place to enter your trade. So in this case, the trend develops into an up channel, very strong up channel. And then again, you can use measure move. This time, you measure from the bottom of this, the first bull bar, which is the start of the trend, until the top here. And then if you do the same measurement, this channel will go up the same as the measure move. Besides the single trend bar, another way to tell the strength of the market is to use the consecutive bars. So to be able to tell the market strength, these bars should be with the same direction, and at the same time, there should be 2 or more bars consecutively. And also, these bars normally should be larger than all the other bars before it. Let's have a look at some examples. Let's use these 3 consecutive bull bars for example. So this is a very strong pattern here. The reason that this is a strong pattern is because if we take a look at the second bar here, the second bar closed above the high of the first bar. And the same thing for the third bar. The third bar closed above the high of the second bar and also the first bar as well. So this means the strength of the market. We also have a semi-strong pattern. From the chart, you can see it's similar to the strong pattern that the second bar closed above the high of the first bar. However, for the third bar, it closed above the first bar's high. However, it is not higher than the second bar's high. So still, it is very strong, though it is semi-strong. Let's have a look at the examples of real trading chart. So on this chart, you can see that the trend starts with 4 very big bull bars here. And then it means the market is very strong because, like we mentioned, the second bar closed above the high of the first bar, and then the third bar closed above the high of the second bar. And then another thing is that as the market goes on and the bars are getting larger, especially the third bar is larger than the first and second bar. Another thing is we can see the pullback here. The pullback is very shallow. It doesn't go down that far enough. That means the market is also strong. and then measure move. So if we measure from the bottom of the bull bar here, and then for the second leg up, it goes up almost the same distance. Here's another example for the downtrend. We can see that there are 5 consecutive bear bars here. And then even though the 5th bar has a very big support tail here, but it doesn't matter. It also means the market is very strong. And then after a small pullback, we can see there's a second leg down with the same measure move technique. And then it has another third leg down. Though the third leg, it won't follow the measure move. But when the third leg comes up, it means the market is very strong. The third way to tell whether the market is strong or not is to see whether there are overlaps among the bars next to each other especially, and also whether the chart is very clear. So if the bars next to each other, then less overlap, not only on the whole candlestick, but also the body part, that means the market is strong. And at the same time, if you can see clear legs of the trend, and also the pullback is very clear with less overlap, so that means the market is also very strong. Now let's have a look at some examples from the real trading chart. So this chart, we can see in the very beginning here, the market moves between the 2 trend lines here. We can clearly see that this is the leg down, leg up, leg down, up and down. And also if we check the bars next to each other, the overlap are very small. So we can see that the market should be very strong if the market breaks either the top trend line or the bottom trend line. So the end result is that the market breaks the bottom trend line and it goes down a lot. If we do a measure that the width of the whole range here, it goes down by 3 times the range width. There's another example on the right. Again, on the left here, for the setup, we can see in the very beginning, we have a leg up here, then we can draw a trend line. However, the market moves up a little bit, so we have to expand the trend line for the first time. And then it goes up again here, so we have to expand the trend line for the second time. This is the indication that the chart or the setup is not clear. The market won't be as strong as enough. Another indicator is we can check the overlap of the bars next to each other. You can see here and also here, there are a lot of overlaps among the bull bars and the bear bars. They come next to each other. So this is the second indication the market won't be strong. The end result is that the market goes up to break the top trend line, and then it goes up only 1.5 times the range width. So using these 2 examples, we can see the clear chart, less overlap, will lead to strong market. We have just covered the first way to use the candlestick to tell the strength of the market. Now let's move on to the second way for the candlestick, which can be served as the signal bar. Before we move on, there are 3 principles that I would like you to take a look and then remember. First, for the trading, the setup determines the whether to trade, not the signal bar, which means the signal bar accounts only a small percentage of the whole trading practice. You shouldn't be relying only on the signal bar for your trading. Second, the signal bar indicates the timing of the start of the trend. So finding the good signal bar will increase the probability to get a winning trade. 3, the stronger the setup and the trend, the less important of the signal bar. So sometimes you have a very strong signal bar. However, if the trend is not strong enough, you won't be able to get your profit target. We can classify all the bars into 2 categories to serve as the signal bar. So the first category is the body of the bar is larger than 60% of the whole candlestick. Whether the tails is above or below the body or which way is larger, it really doesn't matter. Here are some examples of the bars with 60% of the body. And here are the examples of the bars. Body accounts for 70% of the whole candlestick. And here we have 80% and 90%. As you can see that since the body is very big, the trend should be very strong. And then we can use them as the signal bar. The second category for the bars is those with the body less than 60% of the whole candlestick. So for these bars, we have a requirement. We prefer the bars which has a body leaning towards the trend direction. However, like I mentioned before, the better the setup, the less requirement on the signal bar. So now let's have a look at some examples. In the screen, it shows all the candlesticks with a body from 50% to negative 10% if we are doing an uptrend. One thing is the doji bar is not included here. That is because doji bar normally is not a good signal bar. That just means the market is uncertain. And second, we can see that there is a bear bar if we are trading uptrend. That is because if the setup is perfect, like a breakout, so you don't want to wait to see the bull bar before you enter the trade. You can take the bear bar like this. However, the body of the bear bar should be very small. And third, it's the same logic for the downtrend for bear bars as well. Now let me use two examples to show you what kind of bars can serve as signal bars in both weak trend and also strong trend. Let's first take a look at this chart. The market moves very slow and then there's a lot of overlaps, even though the market is still within the range of these two trend lines. We can identify the market is not strong, it is a weak trend. And when the market breaks the bottom trend line here, it didn't break much, and then it pulls back with a bear bar of a very large tail at the bottom. This is a strong support. So this can serve as the pullback. Let's take a look at the bear bars next to this pullback and then see which bar can serve as a good signal bar. So the first bear bar here has a body of 25% of the whole candlestick. So if you enter the trade below the low of this bear bar, what's going to happen is the market triggers the entry and then it pulls back here. And then the next bar, the next bear bar is this bar with 43% of the body here. So this bar is much better than this 25% bar. However, the market didn't go down enough to give you a trigger. And then the next bar is a bull bar. So after this, we have another bear bar. So the body is only 22%. And also the body is in the middle of the whole candlestick, which means the uncertainty of the market. So if you enter here again, it's going to pull back here. And then the last bar, the fourth bar here is a bear bar with 67% of the body. This bar is a very good signal bar. Like I said, any bar with body larger than 60% can serve as a good signal bar. And then you can see what happened after that is the market goes down as expected for our second leg. So comparing these four bear bars, we can definitely see when the market is not strong, it's a weak trend. So it's better that we find out the very good signal bar to enter the trade. Now let's have a look at the strong market. In this market, first, the market follows the trend lines here. And then the market breaks the bottom trend line for 5 consecutive bear bars, very strong bear bars, and then the bars are getting larger as the trend goes on. Even though there's a big support, but the trend is very strong, so we can ignore this. Then we wait for the pullback. And then there's a bear bar here with the body account only 40% of the body of the whole candlestick. However, the body is leaning towards the uptrend rather than the downtrend. But it doesn't really matter. Since the trend is very strong, we can still trade based on this bear bar as the signal bar. We can put the entry below the low of this candlestick here and then enter the market. So basically you can see in the end, this bear bar leads to the downtrend. And then the market pulls back again here with a small bull bar. And then after that, we see the another bear bar with 38% of the body of the whole candlestick. This can also serve as a signal bar, even though the body is only 38%, but the body is leaning towards the downtrend side. And then we enter, and then you can see the trend continues. Another pullback here, this pullback is much larger. However, the signal bar is perfect because it's 84% of the whole candlestick. Then if you enter the trade for a quick scalp, then if you take the profits the same as your stop loss, and then you can get filled in this next bar. So this is a 5-minute chart. So basically, if you trigger a trade at the bottom of this bear bar, you're gonna get the profit in the next 5 minutes. Another thing is that in a strong trend, you can definitely see that there are multiple entry opportunities for you to take the profit. So comparing the weak trend and the strong trend, you can see the signal bars are very important. However, in different scenarios, you should select the good signal bars. I have just talked about how to use the candlestick bars as signal bars for trading. And this is for beginner traders to increase their winning ratios. However, the professional traders would do it a little bit different. Let's have a look and use this chart as an example. If the market goes up with the first bull bar, the professional traders will put in buy order upon the close of this bar or even at the high of the bar by the market order or the stop order. As the market goes on, if they still believe the trend is very strong, they can add up their position. And when the market has a pullback here, when they see the first bear bar here, they will enter their trade upon the close of the bar, so they can use the market order. And then when the market reverses with the first bull bar, they can also add the position by using market order at the close of this first bull bar, or even use a stop order at the top of the bull bar here to enter the market. As the trend goes on, it makes another higher high here, and then when it pulls back, the professional traders will put the limit order at here, the low of this pullback. So in case the market goes down to test this pullback low, they're going to enter the market, but it's a buy order. And then again, when the market goes down here, consecutive bear bars here, what they can do is that they put the stop order at each high of the bear bar in case the market reverse. So they will move their buy order whenever there's another bear bar. So they will move from the top of this bear bar to the top of this bear bar if the market goes down here. And then when they see the bull bar here, the same thing, they can enter at the close or at the top. And then as the market goes on, there are a lot of opportunities for the professional trader to add to their position to gain more profit. As you can see that the professional traders are doing the trading differently. They don't really care about the bars, whether it is a doji bar, it is strong bar or trend bar. They just enter the market whenever the setup is still valid. However, for the beginner traders, I strongly recommend to use the strongest signal bar to enter the market to increase the win ratio. As you become more experienced, you can explore more strategies and enter the market using different orders. Lastly, let me use an example to show you how to do the day trading using the candlestick bars. In this chart, we can see the market follows the trend lines at the top and also the bottom. However, there's so many overlaps among different bars, which means the market is weak. And then for this pattern, we are waiting for the market to break either the top trend line or the bottom trend line. A while later, the market breaks the bottom trend line. And then for the bottom trend line break, we are waiting for the pullback and then to enter a short position. However, because this is a weak market, so we are waiting for a strong signal bar, which is preferred. However, we can also enter with a less strong signal bar if it also leads to good trading based on your historical study. If the probability of that kind of a bar will lead to winning trades as well, you can also enter. And then after the pullback, we can see this bull bar is the pullback, and then next to it is a bear bar. So for this bear bar, the body accounts only 31% of the whole candlestick. However, it is leaning downward. So this can serve as a signal bar, though it is not a perfect one. And then if you scalp, I mean that you enter at the low of this bear bar, you put a stop at the top of this high of this bear bar, and then to scalp the same distance for profit, you're measuring down from the entry level here, the same distance as your stop loss for scalp. And then next, the market goes down to hit your profit target. So you're having a profit right now. And then the next bar after this bear bar, we can see it is a bull bar. So without a follow-up bear bar, that also indicates that downtrend is very weak. And also another thing you can notice is that here we have a previous low here. And then this previous low, the market goes down to test the previous low, but it failed. And then it reversed up. So at this moment, the downtrend probably is over. So we are waiting for another setup. Another thing here to notice is that this bar is very strong trend bar. And if you choose to enter below this trend bar, you're going to get stopped out because the market reversed very quickly. So this is a bear trap. After that, we can see this is a V reversal shape. But at this moment, we're not sure. However, it really forms the shape for the V. So for V reversal, how to trade it? We need to make sure the market first take out the previous minor lower high here. Right now it does. And then we wait for the pullback. And then we wait for another good signal bar to enter the market. After that, we can see that there are 1, 2, 3, 4, 5, 6, 7, 8. 8 bull bars. Even though this is something like a doji bar, but the body is very small, it's still a bull bar. These 8 bull bars consecutively means the market is strong. And then the bear bar is a pullback. Here comes the good signal bar. So though the body is around maybe 30% of the whole candlestick, however, it is leaning toward the upward. So the trend is very strong. So we can enter here. After we enter the market, we need to think about the profit target. Even though there are 8 bull bars here, however, it is not as strong, so the measure move might not work. A realistic profit target is the previous high here. So because the market normally would go to test the previous high or low, like what happened here, it's testing the previous low, but it failed. And then it's going to test the previous high again. It could fail, or it could just reach the target. However, given it is a V reversal, and it's maybe there's a 60% of the time that it's going to hit the target. In reality, it really hits the target here and then with this bear bar. And next, after you take the profit, you will see there is another bull bar. And then this 1, 2, 3, 4, 5 consecutive bars, they form a pattern of stairs. I call it stairs pattern. The characteristic for stairs pattern is that, so relatively, the body of the bars next to each other, they're within a rectangle. And high and lows, the same time they're within a rectangle. Sometimes they are not perfect, but if the perfect one is very strong. So what the stairs pattern tells me is that 90% of the time the trend will continue, and then it will continue with a measured move. Even though the trend might not be perfect strong, like here, we have the resistance at the top and then support at the bottom. And then we need to use this bar to enter the market. This is a very good signal bar. After you enter the market, you can use the measure move. How to do the measure move? We measure from the first bull bar here at the bottom until the last bull bar at the top. There must be consecutive bull bars here. And then we measure again from the bottom of the pullback and the start of the trend. This is the first bull bar, and then measure up the same distance like this height. That you can see if you enter the market here, you're going to get exit in this bull bar. And also you notice the next bar is a bear bar and then another bear bar. The reason that the market comes here and then resist is because some other traders, they're using the same technique to take the measure move as the exit. That's why. And then to sum up for this trading chart, we have 3 trading opportunities. One is short here and then 2 longs here. So from this example, you can see how we can apply the candlestick into our real day trading. If you enjoyed my video, please don't forget to subscribe, like, and comment. You can also go to my channel for more videos. Thank you.